Are you a homeowner looking for a way to unlock the value in your property? Well, today we have an important topic to discuss: home reversion plans versus lifetime mortgages. We'll delve into the differences between these two types of equity release loans, helping you to make an informed decision. So what is an equity release loan? An equity release loan is a unique borrowing method available to older homeowners. It allows you to tap into the value of your home without having to make monthly repayments. Instead, the loan is repaid in a single payment under three circumstances: when you pass away, when you move into long-term care, or if you choose to pay off the loan voluntarily, albeit with potential early repayment charges. These loans are typically used to enhance the quality of life in retirement, whether it's investing in private healthcare, taking those dream holidays, or making home improvements. The possibilities are endless. So what is a lifetime mortgage? Now let's focus on one type of equity release loan called a lifetime mortgage. With a lifetime mortgage, you receive a loan and incur monthly interest. However, here's the catch: you don't need to make monthly repayments. Instead, the interest rolls up gradually, increasing the total debt over time. To better understand this, let's consider an example. Meet Julie and John, both 65 years old, who took out a lifetime mortgage of £65,000, equivalent to 33.33% of their home equity. Their fixed interest rate is 6.4%. Fast forward 12 years and they have both passed away, and the property is then sold for £235,000. But wait, the total amount owed on the lifetime mortgage is now just below £137,000 due to the roll-up interest over the years. After repaying the lender, Julie's estate beneficiaries are left with £98,000 minus fees, of course. And as you can see, the debt has grown substantially from £65,000 to £137,000. So who qualifies for a lifetime mortgage? To qualify for a lifetime mortgage, you must be at least 55 years old, though waiting until you're older might secure a better interest rate. Additionally, your property must be your main residence with no outstanding debt secured against it. It's essential to have paid off any existing mortgages or secured home loans before applying. Some lenders might allow a small outstanding mortgage providing it's paid off with a portion of the cash lump sum. The advantages of a lifetime mortgage: the money you receive is tax-free. There are no restrictions on how you can spend the funds. No monthly repayments are required. You can access up to 60% of your home equity. You can continue living in your home. And you have the option to make interest repayments to reduce your debt, potentially increasing the value of your estate. Home reversion plans explained. Now let's shift our focus to the other type of equity release loan, the home reversion plan. Unlike lifetime mortgages, home reversion plans are less common but still worth considering. With a home reversion plan, you sell a portion or all of your property to a reversion company in exchange for a cash lump sum or regular payments. However, you retain the right to live in your property rent-free for the rest of your life. The percentage of your property you sell to the reversion company is typically below market value. For example, if you sell 50% of your property, you'll likely receive around 30 to 40% of its market value. The remaining percentage is retained by the reversion company and is eventually repaid when the property is sold, usually after your passing or when you move into long-term care. So let's consider an example. Sarah, who is 70 years old and owns a property worth £200,000, decides to sell 40% of her property to a reversion company. In return, she receives £80,000 as a lump sum. Sarah continues to live in her home without any rental payments until she passes away. At that point, the reversion company sells the property for £200,000 and receives 40% of the sale proceeds, £80,000, while the remaining amount goes to Sarah's estate or beneficiaries. So who qualifies for a home reversion plan? To qualify for a home reversion plan, you must be at least 65 years old, though some providers may require you to be older. Your property must be your main residence and there shouldn't be an outstanding mortgage or loan secured against it. Home reversion plans are generally available for properties with a minimum value of around £70,000, although this can vary between providers. Let's explore the advantages of a home reversion plan. You'll receive a cash lump sum or regular payments. You can continue living in your home rent-free. There are no interest charges or monthly repayments. You retain a percentage of the property's value for potential inheritance. And if the property's value increases, you and your beneficiaries may benefit from a larger share of the proceeds when it gets sold. The key differences between a lifetime mortgage and a home reversion plan. Now that we've covered the basics of both lifetime mortgages and home reversion plans, let's summarise the key differences between the two. Ownership. With a lifetime mortgage, you retain ownership of the property, whereas with a home reversion plan, you sell a portion or all of the property. Repayment. In a lifetime mortgage, you don't make monthly repayments, but the interest rolls up over time. In a home reversion plan, there are no repayments as the repayment is made when the property is sold. Amount received. With a lifetime mortgage, you can access up to 60% of your home's equity, while a home reversion plan typically provides a lower percentage of the property's value. Inheritance. With a lifetime mortgage, you have the potential to leave an inheritance, but the debt may reduce the final amount. With a home reversion plan, you can secure a specific percentage of the property's value for inheritance. Choosing between a lifetime mortgage and a home reversion plan depends on your personal circumstances, your financial goals, and your preferences. If you are interested in seeing if you could release equity, then simply click the link in the description below and fill out the short form. It contains a few questions like your property's value and your date of birth, and it will give you access to quotes tailored to your circumstance. It's totally free to fill out, and of course it won't affect your credit score. So click the link in the description below and fill out the short form to try it out.